Hello, thank you for joining me today. My name is John de Carvalho, and I'm the Chief Investment Officer for Moss Adams Wealth Advisors. And the presentation that I'll be giving today is the 4 most important things that investors need to know for 2016. With that, we'll get into the disclaimers here. The topic we're going to address is where interest rates are headed. This was a subject that dominated investors' minds for most of 2015, and we think that this will continue to be on the top of minds as 2016 progresses. As we entered 2015, investors had the expectation that the Federal Reserve was going to raise interest rates for the first time in a decade in March of that year. When they did not move the short-term interest rate, expectations were pushed back to June and then September of last year. And as we head into 2016, we've had the first interest rate increase by the Federal Reserve in December of last year. That was the first increase that we've had in nearly a decade. So the thought is, when will the Fed raise rates again? And how far will the interest rate go on the short end of the yield curve? Currently, we think expectations are too optimistic for rates to go much higher. There are several reasons for why we believe this is true. The first being, this slide here illustrates the effect that the interest rate increase that the Federal Reserve undertook had on the yield curve. We think that this gives us a clue on what could happen in the future should they do so. I'll draw your attention to the middle part of the chart. If you look at the bottom section where the brown bars are, you'll see that the lower brown bars are more in the intermediate part of the yield curve. What that's telling us is that the spread between where the yield curve was last year, depicted by the green line, versus where the yield curve is now, shows that despite their increase in the short part of the curve, intermediate term bonds have not moved up in yield significantly. We know that bonds have an inverse relationship to yield. That means when investors sell bonds, the yield goes up. When investors buy bonds, the yield goes down. So even though the Federal Reserve increased the overnight lending rate from 0 to 25 basis points to 25 to 50, you'll see that investors did not sell off the intermediate part of the yield curve dramatically. Turning your attention to the left-hand side of the chart, you'll notice that those brown bars are much wider. What happened there is the spreads widen much more significantly than the intermediate part of the yield curve. Investors were selling those short-term bonds and moving their duration or their maturities to the intermediate part of the curve. The Federal Reserve only has control over the short end of the yield curve, and they can only influence the intermediate part based on their comments. What this action tells us is that investors don't believe that economic growth will be enough to spur inflation higher, so they're willing to buy intermediate term bonds where they're getting paid upwards of 5 times the yield that they're receiving on the short end of the yield curve. If the Federal Reserve was to continue to raise rates on the short end, we believe this situation would persist, and it's what we call a bear flattener. As the yield curve continues to flatten, you're at risk of creating an inverted yield curve, which we know portends a recession going forward because the cost of capital becomes very onerous in the short term, and over the long term, you're hindering economic growth. This is one reason why we don't think the Fed can be too aggressive in their interest rate increases. The next chart shows us what the global situation is and where the relative value is in the United States versus the 2 other major global central banks. The dark blue line depicts the U.S. Treasury yield curve, the light blue line is the Euro Treasury yield curve, and the red line is the Japanese Treasury yield curve. You can see that the U.S. is yielding much higher rates of return than Euro Treasury bonds or Japanese Treasury bonds. The fact that we're yielding higher, and it could be argued that we're a better credit quality, makes it easy to see why investors are demanding U.S. Treasuries at a very high level. This is also increasing the value of the dollar, and it's making European goods more competitive and Japanese goods more competitive as their currencies continue to fall. This is why we think that intermediate part of the yield curve will continue to receive high levels of demand despite the fact that the Fed is raising short-term interest rates. Therefore, if they continue to raise those short-term interest rates too aggressively, this also lends credence to the fact that we think the yield curve will continue to flatten. Lastly, 70% of our national debt is going to be coming due by 2020. What this means is that they will have to reissue that debt at higher interest rates if the Fed was to increase the short-term rate too much. We know historically that the Treasury issues the vast majority of our debt in short maturities. That means from 3 months out to roughly about 5 years. That's where the bulk of our debt is being issued. As I showed you on the charts previously, the Federal Reserve can influence the short end. So if they were to raise those rates, we're effectively going to have to pay more interest expense on the debt that's reissued. In addition to that, national spending is forecast to go up based on our aging demographic. As our demographic age, that means our automatic spending increases due to Social Security, Medicaid, and Medicare. If our spending is going up at the same time that we need to reissue the bulk of our debt, that means our interest expense is going to grow. There's two ways we can handle that. We can either issue more debt to handle that interest expense, or we can raise taxes. If we raise taxes too aggressively, that would also have a bad effect on the economy, potentially sending us into a recession. These are the reasons why we think interest rates will stay rather muted, and we are not in a sustainable rising interest rate environment. We need time to work these situations out, and it's going to probably last much longer than what's anticipated. With that, I'll end my presentation, and thank you all for joining me again.